Money market, market for short-term debt securities. Money market is a market for short-term securities, namely commercial papers, repos, negotiable certificates of deposits, bankers' acceptances, treasury bills with a maturity period of 1 year or under 1 year. This market is characterized by the fact that the market is liquid and can be turned over abruptly at low cost and provides a level playing field for the requirements of borrowers and short-term surplus funds of the lenders. Basic concepts: monetary and liquidity measures. During 1970, monetary stock measures were introduced by the Reserve Bank of India and later under the working group chaired by Mr. Y.B. Reddy, who suggested more changes in 1997 till 1998. According to these measures, monetary aggregates were classified as M0 or weekly reports for currency in circulation, bankers' deposits with RBI and other deposits with RBI. Narrow money or M1 were categorically currency with public, current deposits in the banking system, and 15% of DTL or demand time liability portion of savings deposits with the banking system. M2 or fortnightly report were M1 included with time liabilities portion or 85% of DTL of savings deposits with the banks, certificate of deposits issued by banks and term deposits excluding FCNRB. M3, also called broad money, is M2 included with term deposits excluding FCNRB and call borrowings from non-depository financial corporations in the banking system. Call and notice money market. The call money market is important in money market where funds may get transacted on an overnight basis, and in notice money market, another money market instrument where the funds are transacted within a period of under a fortnight. Government securities. Short sell indicates sale of government securities by a bank who do not own the government securities with an understanding to deliver the security at a future date. The main purpose of selling the government security is to enhance liquidity in the G-Sec market and to give a view of two-way view on interest rate to the participants involved in the market. Banks also participate and undertake notional short sale where a security is sold short from HFT or held for trade even if it is under AFS or HTM hook, alternate financial services or held to maturity. Treasury bills. Treasury bills are short-term instruments used by the central or state government to borrow and also are promissory notes issued at a discount. They were first issued in India in the year 1917. These are issued to meet expenditure and also to park surplus funds which are temporary in nature from the investors. Treasury bills can be purchased by anyone except state government and are issued by RBI and sold through auctions conducted on a fortnightly or monthly basis. Normally, the face value of treasury bills is rupees 1 lakh or multiples of it thereof. The rate of maturity of treasury bills is 91 days, 184 days or 364 days. The rate of interest of treasury bill is determined by the money market based on the demand and supply of funds in the market. Derivatives. Derivatives are a financial instrument to be settled at a future date whose value is from changes in variables such as interest rate, foreign exchange rate, stock market index, credit index, price of securities or goods, price index, etc. The well-known derivatives include forward rate agreements or FRAs, interest rate swap, interest rate futures, foreign exchange forward, currency swaps, and currency options. A forward rate agreement or FRA is a contract that is financial in nature between two parties and exchanges interest payments for a notional principal amount on settlement date from a start date to a maturity date. On settlement day, cash payments based on contract that is fixed and at settlement rate is made by the concurring parties. Interest rate swap or IRS is a financial contract between two parties exchanging a stream of interest payments for a notional principal amount on multiple junctures during a particular period. What gets exchanged may involve fixed to floating and floating to floating rate of interest in several occasions. Interest rate future or IRF is a standardized exchange traded contract with an underlying asset that is an actual or notional interest bearing instrument. Foreign exchange forward is an over the counter contract that a purchaser agrees to buy from the seller and seller agrees the sales at a specified amount of a specific currency on a specified date in future. The sale takes place beyond the spot settlement date at a known price which is denominated in another currency, also known as forward price. Currency swap is an interest rate swap where the two legs of the swap are assigned in different currencies and the parties agree to exchange currencies at the prevailing spot exchange rate with an agreement to reverse the exchange of currencies at the same spot exchange rate at maturity date. Currency options is a contract where the purchaser of the option has the right but not the obligation to purchase or call option and sell or put option, and the seller agrees to sell or call options and purchase or put options for an agreed amount of a specified currency at a price agreed in advance. Factoring. Factoring is an arrangement in which short-term domestic receivables that are obtained as a result of sale of goods or services are sold to a company known as factor. In the beginning of the 21st century, there were two banks which were involved in factoring, namely SBI Factors and Canara Bank Factors. Both exchanged and engaged in the arrangement of factoring in association with SIDBI, Small Industries Development Bank of India. In the beginning of the 21st century, there were two banks which were involved in factoring, namely SBI Factors and Canara Bank Factors. Both engaged in the arrangement of factoring in association with SIDBI, Small Industries Development Bank of India. First introduced in India based on the report of Kalyana Sundaram Committee, the factor performs the functions that may be maintaining sales or receivables ledger, purchase of receivables, collection of debts, due date debt collections, return reserve money to seller after debt collection, and providing consultancy services in respect of marketing, finance, and production to the customer. The main advantage of factoring is that the seller is no more bothered about bad debt in due date or collection of receivables, since it will be the responsibility of factor and will in turn see working capital management of seller working efficiently, reducing costs and improving profits. Forfeiting. What represents the purchase of obligations which falls due at a future date is forfeiting and is without recourse to the previous holder of the obligation, that arises from export of delivery of goods or services in export transactions. Under forfeiting, the interest in advance for the whole period of credit is deducted by the forfeiter and disburses or sends the net proceeds to the exporter. In effect, factoring is suitable for financing small and short-term receivables for a period between 90 days to 180 days, and forfeiting is used to finance capital goods, mainly by exporters, where the terms of credit extends from a few months to a maximum of 10 years. Leasing. A lease is a contract governed by Indian Contract Act 1872 to use assets against a payment of fixed lease rental, where the owner of assets or lessor transfers the right to another person who is lessee. Reserve Bank of India permitted banks to undertake the business of leasing and hire purchase, which was originally kept at 10% of its total advance. After the period of lease, the lessee can purchase the leased asset from lessor as per agreement between the two parties. Difference from hire purchase. Hire purchase is a contract of owner-hirer, and after the contract of ownership is passed to hirer on payment of the said amount, claiming depreciation after passage of time. The assets in a hire purchase appears in the balance sheet of the hirer, and installments may be treated as partly capital repayment and balance is treated as interest expenditure. For tax benefits, only the interest amount is considered. Financial lease. A lease is financial lease if it secures for the lessor his capital outlay and a return on the funds invested during the lease term, which is also non-cancellable in the lease term. Operating lease. A lease is considered operating lease if it does not secure the lessor his capital outlay and a return on the funds invested during the lease term. Venture capital. Venture capital is a source of funds to finance new deals or technologies involving products or services which are risky but with a high potential of returns. The model of venture capitals is of committed capital in the form of shareholding for the formation and setting up and running of new firms. In short, it is a long-term fund in equity or semi-equity form having strong potential for high profitability, and the fund per se will be used to finance high-tech projects involving high risk. Mainly, there are three forms of venture capital, namely risk capital, which is financial investment in a higher risk proposition, startup capital or seed capital or initial capital, and equity capital involving equity and semi-equity investments. Money market instruments. The different money market instruments are certificate of deposit, where banking system mobilizes bulk deposits from market, which they can attract at competitive rate of interest. Commercial paper, short-term money market instrument issued as a usance promissory note, which is unsecured and privately placed with an objective to enable corporate borrowers and primary dealers to diversify short-term borrowings. Interbank participation certificate, interbank term money, treasury bills, bill rediscounting, call money, notice money, and term money. Money market institutions. This is a discussion on the following money market institutions in India, namely LAF, NDS, and CCIL. LAF, or Liquidity Adjustment Facility. During 2000, Liquidity Adjustment Facility was introduced in India to ensure smooth transition and keeping up to date with technology advancements which were happening during that time in India. The main objective of LAF is to provide funds which will be used by the banks for their day-to-day mismatches in liquidity adjustments. All banks and commercial banks except RRBs and PD, or primary dealer, having SGL, General Ledger account with RBI, and have a current account with RBI are eligible. Repo auctions for injection of liquidity as well as reverse repo auctions for absorption of liquidity are conducted on a daily basis, and the eligible securities are central government dated securities and treasury bills, where repo and reverse repo in CG dated securities are eligible. Negotiated Dealing System, or NDS. NDS was operational during February 2002 and supports the submission of applications and bids for flotation of government securities as well as auction of government securities through a pooled terminal facility located at regional offices of public debt offices. This under liquidity adjustment facility can be used for daily auctions for repo and reverse repo. Clearing Corporation of India, or CCIL. On 30th April 2001, the Clearing Corporation of India Limited was incorporated as the country's first clearing house for government securities and other related market segments and forex. On February 15, 2002, Clearing Corporation of India came into being. It provides a system for foreign exchange market transactions, government securities, and provides a system for efficient clearing of money. CCIL is owned by market participants and promoted by banks such as SBI, ICICI Bank, IDBI, and LIC. CCIL is a limited liability company under the Indian Companies Act 1956 with authorized capital of Rs 50 crore and is managed by a board of directors. CBLO, Collateralized Borrowing and Lending, is an RBI approved money market instrument, is a product of CCIL for the benefit of entities who do not have access to call money market or have been phased out of call money market or have been given restricted participation in call or money market. It is available in the form of an electronic book entry and looks more like a discounted instrument with maturity period ranging from 7 days to 90 days. In order to make market participants borrow or lend funds, CCIL uses the dealing system from Indian Financial Network or Infinet. Membership in CBLO is granted to NDS members, non-NDS members, nationalized banks, foreign banks, cooperative banks and private banks. Membership of CBLO segment in CCIL is extended to banks, financial institutions, insurance companies, primary dealers, non-banking finance companies and non-government provident funds, etc.